Hello and welcome to another episode of Value Validate. A quirky little insurance company has been surfaced by the Sage Seeds artificial intelligence as the value play in January 2026. Now, don't troll me because just last month I was talking all this big talk about how I really thought the moment for financial stocks had finally passed. Many of you following along with the channel might have noticed that our artificial intelligence has kept us invested in financials pretty aggressively since around summer 2023. It really does seem to be the undervalued group of this business cycle. And while we were starting to see green shoots in other sectors, in December, we had a very exciting energy company play that did not follow through, unfortunately. So many things that honestly are tempting to talk about instead of insurance and banking. But then to say that the tone of financial markets has shifted in 2026 as soon as the year ticked over would be a massive understatement. The markets are completely different than they were last year, almost right out the gate. And wouldn't you know it, the financials are back, chugging forward. And when have we at Sage Seeds Capital ever said no to free, favorable risk-reward ratios? That is why the very top recommendation right now, James River Group Holdings, a young, niche, quirky insurance company that, as far as I can tell, has been changing its headquarters location every couple of years. Kind of suspicious, to be honest. According to MarketWatch, we have a market cap of just over 300 million. And hello, that's right, they claim over 5 billion in total assets. That is more than 16 times higher than the current market cap. When you have such a low market cap, a price to sales hovering around 0.2, guys. Well, investors selling at these prices better be very confident that they're selling dog shit because these prices are ridiculously low. My main job as the handler of the Sage Seeds artificial intelligence is validating the value of James River Group Holdings. Let's dive in so that your wisdom can blossom.
This video is intended for educational purposes. Opinions made by me or the Sage Seeds AI are not investment advice.
If we are going to validate this value play, the very first question on our mind should be, does it actually earn profits from insurance underwriting? And guys, what I'm finding is very compelling. It seems like our AI has recommended to us a very prickly thorn in the side of some of the major insurance players, such as Berkshire Hathaway, a legit competitor. And we can see that immediately on the homepage of James River Group's website, an established group of specialty insurance companies. Why would they put the word specialty in front of insurance? Because of the niche nature of their products. And on the products page of their website, when we can find all the major categories of insurance that they choose to underwrite, we're going to see healthcare, casualty, and property make up the major categories. But every time we see this word excess casualty, excess property, excess means this insurance is being sold to other insurance companies, what is called reinsurance. That being said, the niche nature of James River is that most of its customers are actually other insurance companies that are feeling a little nervous about what they've underwritten. In effect, turning James River into an enterprise business, B2B, which for this type of product, looks like we're finding translates into one thing and one thing only, a very fluid sales cycle in which James River is able to pass its costs down to its customers almost instantly. They themselves call this pricing tailwinds, and here they have a graph breaking it down all the way back to 2013. Specifically, the ENS market, this stands for excess and surplus. For our purposes validating this, we're going to call this the enterprise segment of their business, is starting the 2020s decade with an average growth rate, every single year growing by this much. This is 5 times higher than the average growth rate they saw around the middle of last decade. And I'll say it to you guys very directly, very clearly. When you spent last decade earning 4%, that reputation does not match up with the reality of now growing 20% every year on average. And this is increasing, guys. This seems to be legitimately accelerating. I don't believe the reputation of James River has been readjusted since this structural change has completely transformed the financial profile of the company, even though it has been well over 6 years of double-digit growth rates. Again, 6 years is longer than you think. That's structural at that point. All I know is if I were getting a salary raise of 20% a year, I would definitely be acting different than if I were getting a salary raise of 4% a year. Investors in this market don't really seem to think that's a big deal. Now, this is leading to articles which coming out just this week, a German article, and you know these German investors have always loved financials, have always loved insurance companies in particular. James River Group just dropped a plot twist on Wall Street. Is this a viral-worthy comeback play or a value trap we should dodge? Introducing the plot twist, they say that this is a specialty insurance player that mostly lives in the background of the economy. The narrative has 3 pillars. The actual stock price of James River has swung hard over the past several years. Lots and lots of volatility in this market. The second pillar is there's a turnaround narrative, having to sell off underperforming parts of its business over the last several years, which we will absolutely get into the details of in a moment. James River is that turnaround label, which can oftentimes be a value trap, real talk. And a third pillar of small insurance companies typically never win. If James River were to be one of the first small insurers to actually have a massive increase in valuation, well, we've been talking about the business cycle on this channel for years now. It really seems like the financials narrative is finally weakened. Any week now, we might start to see people get excited about insurance companies again, something which has not happened since around 2015, 2016. It might be due. And I'm liking this article. It's got some good research behind it, what the turnaround story actually is in terms of actions. Very important, they exited certain segments which were underperforming by selling those to other people. But they've also increased the defensiveness of their balance sheet with success. This is not a plan to have a stronger balance sheet in however many years, which you can find dozens of those plans all over management boardrooms. This is a success story. It already has a strong balance sheet after the last couple of years. And the only kind of increase in costs that you can really criticize them for is that they're spending more on investor relations, specifically trying to reclaim some of the relationships with investors that got burned by the old strategy. All in all, are we going to cop or drop? I mean, what is this website, guys? Pros and cons. This website suggests that we should cop this if we love turnaround stories, if we're fine with volatility, and if we're willing to dig into earnings reports. However, we should drop it if we don't want volatility, we want a low drama stock. That's never been the way at Safe Seeds Capital. If we get stressed when headlines tank, or if we want a flashy meme level FOMO, we might not get that in a niche insurance business. Well, guys, to give us some important background about what this turnaround means day to day within the company. About 6-7 months ago, August 2025, this press release announced 2 key executive appointments to strengthen the leadership team. We had a CIO and a chief claims officer, which is a bit like a COO within the insurance industry, making moves within the business very, very recently. Immediately interesting thing for us looking into this for the first time is that the claims officer used to have a lieutenant, a vice president of excess and surplus. Well, that role has been eliminated and consolidated right into the claims officer role, meaning that the one claims officer now has direct control over the ENS segment, which we again are calling the enterprise customers. This removes a layer of bureaucracy. As I'm learning about this, I'm realizing that this plays into one of their core strengths. I've already begun to kind of mention this, but I'm going to begin reiterating this over and over again. Selling reinsurance to sophisticated enterprise customers means that their sales cycle is very, very short. By cutting down that bureaucracy at every opportunity, you're just further reinforcing that competitive strength. If you're going to change the pricing of an excess property contract, there no longer has to be a huddle with the vice president to get his okay. More important, this means that at the board of directors level, there are actual moves being made to ingrain this philosophy into the DNA of James River Group. It can also be validated by seeing how their quarterly presentations have slides like this one, calling excess and surplus their core competency and labeling it an attractive market. They want to be very clear. James River is already one of the largest and most concentrated public companies in the excess and surplus exposure. 76% of their written premium is to these sophisticated reinsurance customers. And they've crossed the 1 billion written premiums annually, putting them in the same 1 billion plus mark as companies like Kinsale, Berkeley, AIG, and yes, Berkshire Hathaway right here. And why is this a thorn in the side? Because if you're an AIG, a Berkshire Hathaway, even an Axis, you have other insurance segments that are a larger part of your business today. With limited focus in this world, you are probably going to over-prioritize other segments, allowing this more niche E&S segment that has this huge benefit of a short sales cycle. Again, please don't forget that at any point. You're not going to prioritize it. And so if you're an executive in the insurance segment of Berkshire Hathaway right now, Daddy Warren has just retired. You might tell your new management, oh, it looks like the economics of reinsurance are evolving very favorably. And listen, I know that right now E&S is only 9% of our premium book, but we should start to go all in on this 9%. Maybe we can forget about natural disaster. Maybe we can forget about calamity insurance. All these other things which Berkshire does at a big scale as well. Let's forget about those in order to really try to enjoy the benefits of E&S, which seem real and continuous. This chart, only E&S is growing at 20% a year since 2020. But it's tough. Berkshire Hathaway legitimately would find it hard to justify investing in the 9% that's growing fast when it has the 91% that grows slow taking up most of its time. That's why James River is such a thorn. By the time Berkshire Hathaway has the bandwidth, or any of these large players have the bandwidth to properly align themselves to the philosophy of this new world, James River, 76% concentration in this market, and that is growing rapidly, is going to be continuing to develop its core competency here. I cannot understate how exciting this is in the insurance industry. Insurance companies don't really blow up like this. The closest we can imagine is when there was Enron in the early 2000s, but that was a straight up Ponzi scheme. That wasn't real growth. No. It hasn't been since the 1960s, I think, since insurance business has been going through such a structural shift at the economic level. And this is why our Sage Seeds artificial intelligence is flashing green on this stock in particular. We're not just talking about a price to sales of 0.2. We're talking about a price to sales of 0.2 during a once in a generation shift for the reinsurance industry, well known to be one of the most high return on equity businesses that has ever been invented. We're talking about annualized return on common equity of 19.3%. Now, this does have several non-GAAP adjustments to it. I would argue we should really be looking at a 17 to 16% once you take away some of their decision making. But still, anything in the upper teens, in particular, when your E&S combined ratio is still hovering below 90. So this is a very, very kind of average, middle of the road combined ratio. And it's leading to, I would say, 17+% return, while the company is driving in first or second gear here. If this combined ratio starts to become favorable at any point, there's definitely a convexity to this business. And you could see equity toy with 30 or maybe even mid 30% return on equity very reasonably for at least a couple of years. I don't really love to make future predictions, so I'm not going to include that in my valuation today. But talk about reward versus risk here. We can buy this reinsurer for 20% of its sales. If it has even 1 or 2 good years, we'd be talking about doubling our money every year relative to the price that we paid. Now, whether the market recognizes that value is another point, but the money is going to flow into the balance sheet no matter what the stock price is doing. This is already set up, guys. And I believe that's going to make me want to validate this value story. The Sage Seeds artificial intelligence has clearly understood that the current price is completely unjustified compared to what this company has achieved over the last 2 to 3 years. That takes care of what its actual insurance profit is, but it leaves me with 2 questions. This company invests a lot of its excess money. That's part of what it does. Is the market noticing some sort of ridiculously poor investment judgment, which is causing this discount to be justified? If not, the final question is, why the heck is this trading so low? And so let's peel back the layers on its investment portfolio. The company has about $5 billion in assets. 40% of its assets constitute what it labels the investment portfolio. From there, we see a 4.5% gross investment yield, which is rising, by the way, because currently interest rates are actually higher than that, at least slightly higher than that. So we're making tens of millions of dollars off of this, what I would call a pretty elite duration. I mean, according to this, some of their new money yields are above 5%. Earning that when your duration is still below 5 years is a little bit on the impressive side. It's not, this isn't Warren Buffett or anything. But for a quirky little insurance company, this is more than it has to be. So let me pull this back. If you pay 300 million, 350 million even, that is roughly the market cap right now. You're going to buy into this investment portfolio, which is generating north of 80 million already every year. That is slightly increasing over time. You're looking at making your money back in 3 to 4 years just off of the cash that they have lying around, just off of this investment portfolio. That is if you completely remove the actual main business, which is the insurance business. And so I don't get it, guys. Why are people selling at these prices? It absolutely confounds me. But this is value validate. We need a reason. Otherwise, we don't know what the Sage Seeds artificial intelligence did. Its calculations are too complex to just take at face value. It might make a mistake even though it almost never does. I need to come back to my firm with a reason of why this makes sense. That reason buried deep in a sentence on page 88 of its latest annual report. The reason you guys come to this channel over and over and over again, because I do not let up until I find it. And let me start with a little bit of context, because this final sentence, the last sentence of the page, something we've already heard a little bit about. James River has been doing a multi-year turnaround. They have been, as part of that turnaround, selling their underperforming business segments. One of the sales of its underperforming business segments was to a company called Enstar Group Limited. That's what this sentence is about. At the time this was announced, that this agreement was signed, the management knew full well that its stock price had been going from 15 to 12, 12 to 10, 10 to 8. It had no leverage, and yet it wanted to complete this in order to follow through on its turnaround plan. Maybe they figured it's just one agreement. How bad could it be? Well, 2 million, just shy of 2 million common shares were created, were issued at a share price of $6.40. Kind of brutal, given that the stock price had barely reached $8 and had spent most of the previous year really looking more like it was going to go towards 20 rather than 6. And that month right there, those 2 months from November 2024 to January 2025 have led to a long winter in the share price, a long hangover. Keep in mind, this company had been turning around for already 2 to 3 years at this point. And under these circumstances, a stark drop in price from 8.9 to 6.40, many hedge funds just hit the delete button on the watch list. James River, get out of here. I'm sick of you. You've hurt me too many times. This was the agreement that pushed its core investors too far. Looking at just a simple stock price graph, that happened right around here. And since then, the price did fall below $5 for many months, further exacerbating this complete pushing away of this stock from hedge funds' watch lists. And guys, that seems to be the whole story. A turnaround story that just pushed its investor core a little bit too much. And so nobody wants to stand up and defend this stock. Now, looking at the last 6 months, may be hard to tell here, but our AI is very confident that the volatility has actually been decreasing quite regularly. This might still look a little volatile, but really not in the grand scheme of things. This is a tightening base. Some people somewhere are finally starting to buy up this stock over the last 6 months or so. We have initiated a position, and that position, I make no promises about what it could do. We could sell it tomorrow or we could sell it in 50 years. But I do promise that it will be talked about. We will be following up on the details of how this investment proceeds On the 15th of every month, we will be publishing those updates. That being said, invest safely, always manage your downside and your risk. I'm going to go tell my boss that I finished this and that thankfully this is yet another example of the Safe Seas artificial intelligence noticing something pretty legitimate. To help this channel grow, please share your hype, do your likes, subscribe even if you haven't. My job is made substantially easier through your comments, through your engagement, and the hive mind together can do a better job validating these complex decisions than I ever could on my own. Thank you for watching and see ya, Sage Seeds.